inflation rate this week came out at 6.5%. That's minus mortgage effect. With us in the studio today, we have Bruggemans of First National Bank. We're going to have a broad-ranging talk about macro issues. Kees, I'd like to start on something which is really of great interest to the whole market, and that is the subprime meltdown that we experienced. Is this behind us now?
Oh, no. We are very much in the middle of it. The last 24 hours in the States specifically, spreads have been widening again in the money market. No, they are not out of it, and specifically the commercial paper market is still very much under pressure. Going forward, it's going to be very interesting to see who blinks first in terms of the Federal Reserve and what will ultimately make these markets to function again.
Can this thing be repaired through monetary policy in the US?
Well, that is the question of the moment, and the short answer seems to be with difficulty. Because the markets just don't really want to open up and start functioning again. Or to put it this way, are you prepared to trust your counterparty and trade normally, compared to there being or remaining substantial question marks as to the kind of losses that are still out there, who holds those losses, whose paper is doubtful, and making people just unwilling to trade.
I believe Bernanke and Bush are both going to talk about this subject later today. So we'll see the outcome of that. I want to talk about South African interest rate trends, but I think we should start off with CPIX. There was some alarm at the figure of 6.5%. Are you as shocked as some of the other commentators about the inflation rate that's just been published?
Well, clearly the goalposts are moving, and they are moving monthly or quarterly. To a degree that, yes, we can identify that there are external shocks operational already for the past year in terms of oil and food and, of course, the currency. But also, I think, increasingly, it is the domestic situation. And we're talking really here the labor market and the extent to which wage and salary increases are drifting higher. And still looming are basically infrastructure tariffs, the ESCOM increases that are coming, to the extent that is going to be higher than inflation. And all these things add up, and it seems to be every month, every second month, every third month, we have a surprise on the upside, not on the downside.
And yet the governor was suggesting that the rate might start to ease in the middle of next year.
Well, it depends on what you want to emphasize. What was significant to me is 10 days ago that he spoke, where he specifically, I think, made mention that the economy was growing faster than its potential. And that this was being reflected in a rising underlying inflation rate. He didn't mention the labor market, but in everything he had to say looms our domestic labor market. He wasn't emphasizing the external price shocks. For me, that sounds like this economy may have to cut back a little bit.
Slow down.
Slightly.
Through pressure of interest rates through monetary policy?
That is the way it is done.
Interesting that the US eased the discount rate.
Under juris.
Under juris, but that's not the beginning of a new trend. That the whole idea that money was going to be more expensive suddenly seems to be changing, certainly in Europe and the US.
Yes, but that is the difference between having a financial crisis, which they are having, a full-blown one. So they have to match an illiquidity condition in the market, and they're having to operate as lenders of last resort on the one hand. And on the other hand, they have to look at the macro situation and decide what level of interest rates is appropriate. Now, we do not have that duality. We are really only preoccupied with the macro condition because we're not having a financial crisis.
Yes. Now, if you strip out the effect of oil and just look at the domestic situation, does it really help to raise interest rates, to pump money out of the system, so to speak, in order to combat rising inflation? Is there not a less blunt tool to moderate the economy?
Well, first of all, if we do strip oil and food out, and we left at CPIX ex food and oil, in the past month that rate increased from 4.8 to 5. The point is that for the whole year, every month, that rate has been rising. We're now at the upper end of the intervention, the target zone, and from a Reserve Bank point of view, this is having impact on people's expectations, We're seeing it reflected in the condition of the labor market, and if they don't do anything, it will just continue to worsen, given the strength of the economy. So are you prepared to take that risk compared to saying, no, I have to somehow make sure that this upward drift in conditions is ultimately arrested? If that is the bad news, the good news is that they're basically shadowing inflation higher. They're not really increasing real interest rates. So they're not ultimately going out of the way to really cut the economy back. They're merely trying to stabilize things.
Okay, let's talk interest rates as a result. If we're looking at inflation of 6.5, where do you think that they might go? I mean, in the next, let's look out 6 months and a year.
Well, the projection is now, post these latest numbers, both for CPIX and for PPI yesterday, that effectively CPIX will be in a 6.5 to 7 range for the next 6 to 12 months, and then supposedly it will be coming down. But just how much it will be coming down and how deep it will fall back into the target zone is very uncertain at this point. For the Reserve Bank still to raise rates now by 0.5%, it is merely keeping real rates stable. In other words, all it is doing, it is shadowing this upward drift in inflation performance. And for me, that makes it highly likely, unless there's a deepening of this financial condition internationally and affects us. But without that, it makes it highly likely to me that they will raise another 0.5% in October.
So, you know, the wage settlements don't seem to be out of line, 6% generally and 8% now for the miners. Does that worry you? Do you think it is? I mean, is that going to fan inflation much?
No, I don't quite accept those numbers that you're mentioning there. The average for wage and salary increases was about 6.5 in the last year. I think that is more now in the 7.5. The unions are higher, far more stronger unions. And by the way, that drift hasn't really come to a standstill yet. And that is the wage settlements. If you look at what is happening to scarce talent, and the premiums that are increasingly are required to be paid, at least in certain sectors, then on average, the wage bill growth is continuing to accelerate. And that is something that I'm sure the Reserve Bank doesn't approve of.
Okay, now let's postulate slightly higher interest rates. What does that mean for the rand?
Well, it tends to support the currency because it gives you a higher yield. There are some people who like to emphasize the growth argument. You're cutting back the growth. Therefore, outside parties are not prepared to send their money here. Therefore, the rand will weaken. Well, that is not what we have seen over the last 24 hours, as specifically the idea of another interest rate increase is hardened. My sense is that higher interest rates under these kinds of circumstances won't necessarily cut growth back too much, but at the same time it gives a nicer carry to foreign investors. We are on high yielders, and it in fact increases the appetite for us and the rand strengthens.
So looking at the capital account, I mean, we've had big deficits on the current account and a large amount of capital flowing in to make up. Is that hot money? Could it fly? I think 60 billion net purchases of JSE shares in the past year. What do you think about the mobility of that capital?
Well, we have a current account deficit of 120 billion, and we have to fund it. And we are primarily funding it with, for example, portfolio money. So that is foreign appetite for our equities. And the question is, will that appetite be there? Could it at some point suddenly come to a halt? Well, there must always be a probability that something will happen internationally which suddenly makes people more risk averse. I mean, the past month in the United States and Europe has specifically shown it up in the credit markets and in the interbank markets, not in emerging markets, not on the currency side. But it could still happen. In fact, it has been happening in the way that the Japanese carry trade has switched off and the Australians and the New Zealanders have been having the pressure of that. We have been sitting in between these two shocks and have not this time been affected too much by that, although the rand has gone down somewhat. Could it happen? Yes, it could. But the economy would probably adjust to that. My sense, however, is that I think capital flows will continue, even though we will from time to time have events. We had one in May last year, we had one in February this year, and we're having one this month. But on average, I think the funding will be there, and the currency doesn't necessarily have to get out of line too much.
Okay, so taking all this into account, what are we looking at in terms of growth prospects?
Well, the growth in the first half was 5.2 year on year. I would expect slightly slower in the second half, but that still averages out to a 5. And by the way, the first estimates in the year are always underestimates, at least they have been for the last 8 years. So unless something has changed, the actual performance was faster than the 5.2. It suggests to me we have 5 this year, and we may next year have in the 4.5 to 5 range.
So, just looking at the sentiment about SA, some people think that we're sliding to another Zimbabwe, the alarmists. You are very positive, have been ever since you wrote your book. Why do you discount the paranoia of a lot of people?
Well, I cannot really speak on behalf of other people, but I would suggest there's a lot of historic pessimism there, and that creates examples which people are prepared to follow, compared to, yes, sticking to the facts, and the facts have been very encouraging.
Okay, thank you very much indeed.
Pleasure.
So.